Good afternoon and welcome to our virtual class in your subject, the AFN 6102, and this is Financial Management. In our discussion this afternoon, this is about major sources of long-term financing. And this is actually the part two of the topic that was discussed last week. And I'm your professor, Susan Maminta from AMA East Rizal branch. In today's discussion, you will learn the following. Learn to identify the major sources of business capital, understand the nature, the features, the pros and cons of these sources, and calculate the intrinsic value of preferred shares and compute the ordinary shares valuation using the finite and infinite period methods. Also understand the leases as source of capital. So what are the major sources of long-term financing? These are the bonds, the preference share, the ordinary or common shares, and the lease. Now let's have this bond. Now, although this was discussed last week, a part of this was discussed last week, just to give you a little review, that the bond, of course, is a promise that is under seal, like this one. No? So you have that the face value and with the seal and the interest rate is clearly stated here. So there are other agreements. Okay, what is this underwriter? Okay, the underwriter are just the trustees, no? The one mediating between the bondholders and the issuing company. So the other agreements between the underwriter and the issuing firm in trading bonds are the following. One is the investment bank can negotiate directly with the issuer. Two, the underwriter can participate in bidding for the purchase of bonds. Number three, an investment bank can be a sole underwriter by acquiring exclusive right to sell the bonds. And the investment bank can make an agreement with the issuer to sell the bonds at the best market price it can for issuing company and not guaranteeing a fixed price with the selling firm. So in other words, the underwriter is the one doing the marketing strategy to the bondholders, no? And also, the underwriter will be the one guarantee the capability of the issuing company in paying the bond to the bondholders. So, in case of default, the underwriter will be the one held liable for non-payment of the issuing company to the bondholder. So, there are advantages of using bonds in the capital structure. One is that the long-term debts are less expensive and the interest payments are deductible for tax purposes. And because in bond, you have to pay interest on the bondholders, and that interest paid to the bondholders can be used as tax deductible. Well, in dividends, of course, that is not covered by an expense because that dividend is part of the retained earnings or part of the earnings of the company. So there are many investors consider this as relatively safe investment. Yes, of course, because in bond, there's no such thing as speculative risk. No? That means that in speculative, there is possibility that your bond will have this lesser value. No matter what happened in the market, okay, the value of your bond remain the same until the time of maturity. The bondholders are paid interest and do not share in the extraordinary earnings of the firm. So since you are only the bondholder, that means you will be only entitled for the interest due to you by the issuing company. So even at the time that the company has this multi-million earnings, still the bondholders is not part or one or the bondholders is exempted or will not share in that earnings. The bondholders are not corporate voters, no, they are just the one provide the capital to the company, and but they don't have that right. So they don't have that participation in the decision making of the company. The bond quotation costs are lower than those of ordinary. So what are the disadvantages of utilizing bonds? These are the long-term debts can cause the firm's bankruptcy if it fails to meet interest payments. So failure to meet the payment will give the company this penalty charges, and for that penalty charges, interest might be in compounded computation. And for that excessive unpaid interest, this may lead to firm's bankruptcy. And the fixed charges on bonds other than income bonds increase the company's financial leverage. This is unfavorable for firms with unstable income. So why? Because if you have that unstable income and you have this fixed payment of interest, so that will be a problem to you if you don't have that earnings. The bond repayment at maturity involves a huge cash outflow, of course, that is paying the principal amount already, no, not only the interest, but also the principal. So that's really a huge cash outflow. So the officer in charge in handling the finances or financial management of the company must be aware that there must be a schedule on the principal payment of bonds to avoid this overused cash outflow of the business. The bonds restricting agreements may hamper the firm's future financial flexibility because in bonds you are with agreement that no matter what happened to the company, whether losing, then you are committed to pay the interest, no? And also the principal upon maturity. And for that matter, there is a problem in the flexibility of the finances of the company in the future. So what are the bond attributes and prices? Of course, the par value, and that is the face value of the bond. The contract interest that must be stated in the certificate of bonds or in the contract. And the coupon interest rate is also clearly stated, and sometimes, okay, the company provides that coupon, so there's no more additional documentation in claiming the interest by the bondholders, no? Just present the coupon interest, and then they can get already the interest due that is due with them. Another attribute is the market interest rate or effective interest rate. So because this bond is just like a lending, no? Borrowing money by the issuing company. So of course, one of the factors in determining the interest is the prevailing interest in the market. And also this maturity is the date or time that the bond issuer returns the par value of the bond and terminates it. Not only the interest that is one of the bond attributes, but also the market price of the bonds, no? The bond's present value, which is the total of the present value of the principal amount or payment, and the present value of the cash interest payments are included in the valuation of the prices of bond. The present value means the amount that investors would invest now to receive a greater amount at a future date. Remember your annuity table that we have that future value of 1 peso in that year. So another bond attributes is the yield to maturity. This refers to the bond internal rate of return. So that is about the yield, the income to be received from investment in bond. The current period yield pertains to the ratio of the annual interest payment to the market price of the bond. That means current yield, that is about the annual interest payment to you by the issuing company. The indenture is an arrangement between the issuer, and that is the issuing company, and the bond trustee, who represent the bondholders. So it includes the specific terms of the loan agreement, the description of the bonds, and the bondholders' right, the rights of the issuing firm, and as well as the responsibility of the trustee. Also in bond, we have this bond premium, that is the excess of the bond issue price over its maturity or par value. While a bond discount is the excess of the bond's maturity or par value over its issue price. We have also credit quality risk that refers to the possibility that the issuer of the bonds will not be able to meet timely payments, and that is a risk. No? So if we have a credit rating, we also have bond ratings, and that relates, these ratings relate to the opinions or perceptions about the future risk potential of the bond. So we have these factors that affect the bond ratings, and these are: one is profitable operations, two is little inconsistency of reduced earnings, 3 is the firm size, 4 is the less usage of subordinated debt, and the number 5 is less application of financial leverage. What are the different types of bonds? We have the unsecured long-term bond and the secured long-term bond. Now, let's first discuss this unsecured long-term bonds. When we say unsecured, there's no collateral, there's the security on that investment. No? So income bonds usually issued during the reorganization of a company that facing problems. So this requires interest payments only if earned, and the non-payment of interest does not precede insolvency. Since this is just a reorganizing a company or a startup business, so it is normal that there is deferment of payment of the interest, but it doesn't mean that the company has this insolvency problem. No? It's just that they are in the starting up of the business, but there's no problem on the receiving what is due in the interest, because the unpaid interest will be accumulated and must be paid prior to the payment of dividends to shareholders. We have also these debenture bonds, bonds that are backed only by the good faith of the bond issuer. So you believe with the credit worthiness of that bond issuer or the company issuer, then you have that you subscribe or you bought a bond with that company because you believe that they have that credit worthiness. The subordinated debenture are bondholders' claims that are honored only after the claims of the secured debt and unsubordinated debentures have been satisfied. Okay, so after payment of the secured bond, that's the time that you will be paid if you are the subordinated debenture bondholders. Now let's proceed with the secured long-term bond. That means this is backed up by collateral. An example of this is the mortgage bond. This mortgage bond, this is the type of bonds that is secured by real property. So the value of the real property should be greater than the value of the mortgage bond issue. So if the issuer fails to pay the bonds at maturity, The trustee can foreclose or sell the mortgage property in order to pay the bondholders. So if there's no trustee in that bond, okay, the bondholder can proceed, okay, with the selling of that mortgage property to get his investment from the bond. And another, under this subclassification of mortgage bonds, we have the first mortgage bond, the second mortgage bond, the closed-end mortgage bond, the blanket or general mortgage bond, the open-end mortgage bond, and the limited open-end mortgage bond. Now let's discuss this normal, the regular. Okay, the regular is the first mortgage bond. That means you have the first priority in the payment if in case of default by the issuing company. So from the sales of that mortgage property or mortgage bond, then the first mortgage bond holders will be paid first, and that the next will be the second mortgage bond. Now, for example, you have that real property mortgage by the issuing company in the amount of 5 million. So the first mortgage bond, okay, released the money to the issuing company at 3 million. Will the second mortgage bondholder release money to the issuing company at the amount of 2.5? So the first, in case of default of payment of the issuing company, the property that is the security in that mortgage bond, then the first mortgage bondholder has this priority in receiving the payment of his bond. So the remaining 2 million will be the value to be received by the second mortgage bondholder. Okay. Now, the blanket or general mortgage bond, that means the all assets of the company are utilized as security. So this one, that means the in case of default or bankruptcy of the corporation will realize the assets of the company, or just simply converting the assets of the company into cash in order to pay the bondholders, no? So because this mortgage bondholder, they are covered by this blanket or general mortgage bond. The other types of bonds are the euro bonds, the floating rate bonds, and the treasury bond. So for euro, that means bonds that were purchased by the foreigners or other parts of the world that have the transactions in our country. Floating rate bonds, that means there is a variable rate bond. That means the interest payment is not fixed, and the interest payment depends on the market conditions. Well, a treasury bond is the safest fixed income investments as perceived the investor because it is backed up by the government. So the government will be the issuing company to the private people who wants to help the government by buying bond issued by the government, and that is what we call treasury bond. So now, in terms of retiring debts or retiring of the bond, take note that bonds is a kind of debt, no? And there are different methods or ways in retiring debts, and that is one is serial payments. That means the maturity or paying the principal bondholder will depends on the serial number of the certificate. Another one, there is what we call conversion. That means you are retiring the debt into bonds by converting that into ordinary shares. So instead of getting the money in the company for this bond, no, the bondholder will not get the money. Instead, use that money in buying these ordinary shares of the company. The call provision is callable bonds that are bonds that the issuer may call or pay off as a specified price whenever the issuer wants. So the bonds give the issuer the benefit of low interest rates, that the call price is higher than the bond's par value. And the difference is what we call premium. Another one is bond refunding. How is this? This is the process of retiring old bond issue prior to maturity, and that replacing it by a new bond issue. It occurs when interest rates have gone low. So the decision can be arrived after comparing the present value of the benefits from refunding versus the present value of the cost, using the after-tax cost of borrowing as the discount rate. Okay. Another major source of finances or financial of the business is this preferred share. This is a kind of equity that gives its owner some advantages over ordinary shareholders. And there are benefits on preferred share. Okay, what are the benefits? The right to receive dividends before ordinary shareholders, and the right to receive assets of the company before ordinary shares in the event of the firm's liquidation. So that is, from the term itself, preferred rights on the dividends and on the assets of the company in the event of liquidation, firm's liquidation. Now, their condition when issuing preferred shares is favorable. Okay, there might be some problem in issuing ordinary shares, so the company resorted to open up a new kind of equity or shares, and that is the preferred. Or another one is earning or profits are used to make additional leverage appealing to investors, because like the company, the company has this record that they have that profits in such amount, so they can use that as a leverage in appealing to investors to get to buy their shares, their stocks. Additional loans that create considerable risk. Of course, instead of getting loans, you resort to have that preferred shares to be open to the public because of consideration of risk. The low interest rates lowering the cost of preferred share. Okay. So as I have said, the shares of the stocks also consider the market conditions in terms of rates, prevailing interest rates. The company's high debt ratio proposing a mixture of equity financing. So if the company resorted to financing, then the debt ratio will also be high, and that is not a good financial ratio in the company. So instead of getting a loan, you better have these preferred shares offered to the public, and for that matter, that is not debt, that is equity. So what are the attributes of preferred share? Of course, there is par value, that means the face value of that shares, no? And that they have that dividends. Okay, the dividends, that is the income, okay, from the shares of the stocks by the stockholders. And the cumulative and non-cumulative dividends. So cumulative dividends are those that not paid for a particular year. But while the non-cumulative, if dividends are not declared in any particular year, they are forfeited. That means for that particular year, there will be no dividend, even if you are a preferred shareholder, because you have this non-cumulative kind of preferred share. Now, another features, the attributes of preferred share is the call feature and sinking fund. Preferred shares have no maturity date. This allows the firms to buy back the shares directly from its holders or owners, but at a price higher than its par value. Convertibility had the choice of converting preferred shares to ordinary shares. And voting rights, of course, the preferred shares has no voting rights. They have these participating features that give its owners the right to share in the profits above and beyond the declared dividends, if this is agreed upon before buying the stocks by the preferred shareholders. Maturity, most preferred shares have a sinking pan, and therefore an effective maturity date is stated clearly. So what are the pros and cons of the preferred share? That the preferred share can be easily sold to investors who are very cautious on the safety of their capital and want to receive a regular and fixed return. Okay? And when the company profit is not sufficient, dividends can be postponed. And the preferred share has no voting rights, and the preferred share do not establish any mortgage or charge on the assets of the company. So the company can use their fixed assets in raising future loan. A company can issue redeemable preference share for a fixed period, that the risk of overcapitalization is eliminated because the preference shares that is being offered is redeemable. Okay? And for that matter, the capital structure remains flexible. So the disadvantages of preferred shares are: preferred shares have no minimal voting rights, of course, that was mentioned also a while ago. The preferred shares have bigger after-tax cost of capital than left. Okay? And this is because dividends on preferred share are not deductible, while interest is deductible for tax purposes. The preferences of preferred shares when it comes to dividends and assets in case of the company's liquidation may put at risk the ordinary shares return. Why? Because the preferred share has these preferential rights on the assets of the company in case of liquidation. When the preferred shareholders are already satisfied, okay, then that's the time that the ordinary shares can claim their shares to the assets of the company. So there are different valuation of preferred share. One is considered a hybrid investment or security, because this preferred share also entitles for a regular dividend, no? And at the same time is a kind of shares that is has this gain or loss in the market. So it's called the hybrid. Well, another valuation, it has the qualities of share and a debt, no? Just like bond. No, it's just like a bond, but it is not a bond, it is a share. Okay? But we are talking the qualities because of the payment of regular dividend. Shareholder is a part owner of the firm, just like an ordinary shareholder. It has fixed payment in the form of dividend. Though they are a shareholder part owner, but they have this fixed payment of dividend. And the value of the preferred share can be calculated by discounting each of the dividend payment. So that is part of the valuation of the preferred share on the dividend payment made in their stocks. Another, okay, the fixed dividend payments can be treated in perpetuity and be discounted using the investor's required rate of return. Perpetuity is an annuity with an infinite lifespan. So the concept of a perpetuity is also used, the dividend discount model. When you say discount, we are going to lessen the value that is stated in the face value of this share of stocks, going to discount. So I have here an example of a computation of a preferred share. For example, ABC company pays an annual 10 pesos dividend on its issue of preferred share, and the investor requires an 8% rate of return on this preferred share. So what will be the value of the preferred share? And that is very simple. You have to divide the dividend by the rate, no? So 10 divided by 8%, and that gives you 125. That's the value. Now, let's proceed with this another source of major source of finances in the company is this what we call ordinary or common equity share. Now, take note that in a corporation, the ordinary common stockholder can stand alone even without the preferred share. No? But if you have that preferred shares in the corporation, that means there is an existing ordinary shares. No? The corporation cannot have preferred share alone. Okay? It should have, the corporation must have this kind of equity, and that is ordinary. Now, going back here, known as common stock, that is a common form of capital stock or share. Kaya the word common. The word stock is meant to be common stock or ordinary share unless designated otherwise. So the investors of ordinary shares take the ultimate risk with the issuing firms as the companies makes no promises to pay them. So in case of liquidation, the first one to be paid are the creditors, followed by the preferred shareholders, and that's the time when there are excess. Okay, in the liquidation, that's the time the ordinary common shares will be paid. If the company is successful and earns profit, it will pay dividends, but if the company's net income is too low, it may option not to distribute the dividends. They have that option. If you are a common stockholders. So there are two valuation methods of ordinary equity shares. Okay, one is the finite period dividend valuation, and the other one is the infinite period dividend valuation. So for example, under finite or finite period is that Mr. A intends to buy ordinary equity share of Element N Corporation on January 1, 2017 and sell them at the end of the year. Then he expecting that the corporation will pay $8.50 cash dividend per share. He also plans to sell the shares at 60 pesos each. So his required rate of return is 12%. So what is the value of ordinary equity share to Mr. A? So very simple. You just simply add the this 8.50 cash dividend to the value of the shares, no? So 8.50 plus 6, 8.5 plus 6, that is 68.50 to be divided by the 12%. Okay, and that gives you 61.16. Well, the other one, okay, the other method of getting the value of the ordinary equity share is that on the same problem that we had that January 2017, expecting 8.50 cash dividend with a required return of 12%. But there's no, what is the difference? There is no plans to sell the shares, no given value on this matter. So how are you going to get the, by simply divide the dividend by the percentage, the rate, okay? 8.50 divided by 0.12%, that is 12%, and that is 70.83 as the value of this, okay, the indefinite, okay, indefinite method of infinite period dividend valuation. Now, the last major source of capital is this lease financing. This was discussed in our previous virtual classes, but we need to include just to complete, no, the sources, the major sources, no. So the lease financing, as we all know, is this a contractual arrangement between two parties, and these two parties are the lessors and the lessee. So the lessor is the one who owns the property. Okay, for example, lessee needs a truck or a delivery equipment for his business, but the problem, he has no money. So he asks this lessor, okay, providing money in buying this vehicle, delivery vehicle. So the lessee will be the one using this vehicle for his business, and in return, the lessee will pay. They will pay the lessor the amortization every month. But in the agreement that in failure of paying in 3 consecutive months, the amortization will have that the lessor has the right to confiscate or get the property from the lessee, because of non-payment or default in paying the amortization. Okay, so there's no problem since that this is at the very beginning, this vehicles is under the name of the lessor. There's no problem on the lessor in getting this property, this vehicle. Now, in the event or in the case that the lessee has fully paid this amount, then the lessor will transfer the ownership to the lessee. Okay, and of course, since this is a leasing, the amount, the amortization paid to the lessor can be used as a tax deductible because this is a lease agreement. And as if that the lessee is just renting this vehicle for his business use. Okay, because as the documentation, it's really in the name of the lessor. Okay, so that ends my discussion today, and now giving you my last slide. And class, again, thank you for listening.